Hello, everyone, and welcome to The Buck Stops Here. I'm Catherine Murray. Well, as we know, the markets in 2022 and also, of course, in 2023 are really focused on the U.S. Federal Reserve and what they may or may not do as it relates to combating inflation. Of course, when we see the markets move higher, the expectations are that they have been fighting inflation just enough to be able to pull back on that tightening, and therefore we do get the rallies. And of course, the opposite is true as well. So let's try to dissect in terms of where we actually think the Fed is going to go, and it's a perfect day to do that. It's January the 12th. I do pre-tape this, and today we have Barry Allen joining us. He's the CEO of DMAT Capital Management. And Barry, welcome. And of course, we got the U.S. inflation reading, CPI, this morning. So I want to start there. What is the right read?
Well, interestingly enough, it came in identical to expectations, which is pretty rare. And there are the headline numbers coming down pretty quickly. The core inflation number is coming down, but not as quickly. And there's a lot of kind of distortions in the data because of how they calculate housing costs and owner's equivalent rent, which actually went up during the month, which is anecdotally probably inaccurate. But overall, it's coming down. The trend is important. It's coming down, and it's coming down at a reasonable pace. And I think there's reason to believe that it'll continue to come down at a reasonable pace.
So what does that mean then in terms of the U.S. Federal Reserve? Are the bulls correct in recognizing that the U.S. Federal Reserve does not have to tighten as much as the previous pace, and therefore the market can actually unleash, as it is doing, and continue to rally or find some support at least?
I think that's kind of the consensus view, but I think if you look underneath the numbers, there's some contradictions there that lead me to believe to be much more cautious than the market's doing. I think the Fed is still going to hike rates at least two more times and maybe three. After this number, it appears the Fed members that were in the 50 basis point hike camp in the next meeting have softened it to 25. But I think that it's still very clear that the Fed is going to take the terminal Fed funds rate above 5%. And it's going to be somewhere between 5 and 5.5, maybe in the middle of that. I don't think the story is really what the Fed is going to do. I think the story is how the market's going to interpret it. And it appears to me that the market is, kind of enjoying its normal early year optimistic kind of view of things where reality hasn't quite set in for what the likely probability of the economy and earnings and how long the Fed is going to maintain the rate, because that's really critical. The market is expecting rate cuts this year. The Fed rhetoric is definitely not in that camp, and it remains to be seen how that plays out.
Right. There's a real disconnect in terms of what the Fed is saying they're going to do and what the market believes they're going to do. But I want to go back for a second. Why is it that you're cautious? What is it underneath the surface that makes you concerned here?
Well, I think the critical thing here, Catherine, is that we really don't have any idea what the legs of monetary policy are going to play out to be this time, because this isn't a normal economic cycle. The recession was caused by a pandemic, which essentially caused the economy to stop dead in its tracks. To counteract that, we had massive monetary and fiscal stimulus, which not surprisingly caused inflation. I think it surprisingly that inflation went as high as it did.
Right.
Um,
Okay.
and,
Barry, I'm gonna
it's
stop you right there. I'm gonna stop you right
yeah.
there, and we'll pick it up on the other side of the break. Barry, we were just talking about kind of how we got here in terms of the higher inflation and how, I don't know, maybe it's a little bit different this time because we haven't seen this type of monetary policy and you're talking about a bit of a lag effect. So what does that mean then?
Well, I think that because this recession or recovery was induced by a pandemic and we had enormously strong monetary and fiscal responses, we don't really know what the monetary policy lags are. It's obvious that the lags are going to be shorter this time around, but we don't know how much shorter. And I think there's a great deal of a certain uncertainty around that. And the market is anticipating rate cuts because they think that the tightening of monetary policy is going to slow the economy very, very quickly. And I'm not certain that that's the case.
Why are you not certain about that, Barry? If even just take a look at, and I think this is what people are really focused on, is the employment picture. And you are hearing more and more companies, predominantly in tech, and tech doesn't account for the majority of jobs out there, but you're really starting to see companies make layoffs. And the expectation from what I hear is that more will come. And quite frankly, that CEOs didn't want to do this before the Christmas time period, and now we're going to see more of that. Will that not cause some severe weakness within the labor market and therefore the overall economy soon?
I think it'll create weakness, but I'm questionable as to whether it causes severe weakness enough to make the unemployment rate go up. And I think that the pandemic essentially decreased the labor force participation rate significantly. I think people are still leaving the labor force at much faster rate than we've been used to over the last 15 or 20 years. And the layoffs are offsetting that. And, so you've got an offset between declining labor force, which is naturally happening because of the baby boomers and then exacerbated by the COVID pandemic, against the layoffs. And so far, it's been an exact kind of match. The unemployment rate is still at 3.5%, a record low. And if this continues, the Fed isn't going to be able to get the unemployment rate to 4.5 or 5, and wage growth isn't going to decline. And if that happens, then the Fed isn't going to be able to cut, and the market is completely mispriced if that happens.
So it sounds as though that's the side you're on.
Yeah, like I just don't think anybody has any idea. The models don't work for a pandemic. But the evidence right now is that despite all the layoffs, the unemployment rate isn't going up and jobless claims went down, and it's very close to 200,000, which is almost rock bottom.
Yeah.
And maybe there's some seasonal effects there because of Christmas and the holidays and that. But until we see jobless claims going up to 260 to 280, the unemployment rate is not going to rise. And if the unemployment rate is not going to rise, then the Fed's not going to be cutting.
So do you think then the Fed's got their eye on the wrong ball? Because what you're describing is a dynamic that's not going to change because of demographics, essentially. That's one aspect of it. So if they actually look at other aspects of inflation, which, as you say, the trends are coming down, why won't their focus be that and therefore start to pull back on the tightening? Again, I'm putting out the bull case.
Yeah, like unemployment is much more political than inflation. Inflation became political over like 4 or 5%, but inflation under 4% isn't political, but unemployment is always political. And this Fed has proven to be, quite political. After all, the Fed chairman is appointed by the president.
Right.
And so I don't think they're looking at the wrong place, but, and I think that's why the Fed is saying we're going to have to keep rates higher for longer because inflation isn't coming down close to their targets and the unemployment rate isn't rising. And as I say, the market is priced for rate cuts, not for a prolonged
Okay.
period of
Okay.
rates at
We'll
5%.
take. Barry, when we think about the market, you're basically bottom line. We're going to get to what the right strategy is going to be in a second, but basically the market's not pricing in the correct potential strategy of the U.S. Federal Reserve. I want to bring into the equation as well, of course, what the U.S. dollar is doing, the weakness we've seen as of late, and if that's the correct move. It doesn't quite make sense to me, given what you're saying.
Yeah, well, I think it's logical that the US dollar weakens when you're getting close to the end of a hiking cycle because it's obviously related to relative interest rates around the world. And the market knee-jerk reaction is when the US dollar is weaker, that is supportive of equity corporate earnings, and therefore equity prices and credit spreads are moving positively. That's their knee-jerk reaction, but underneath the hood, a weaker dollar tends to drive up commodity prices, particularly oil, and a weaker dollar works against falling inflation. And so it's kind of be careful what you wish for with a weaker dollar, because if the US dollar continues to weaken, inflation is not going to fall as quickly as the market is anticipating. And again, you get back to the Fed is less likely to cut when inflation is sticky at well above their target levels. So a weaker dollar is short-term good for markets, but longer term, given this inflation picture that we're in and how the Fed is positioned, it's actually a negative and could cause inflation to fall much more slowly than the market's anticipating.
And you're saying that because with a weaker US dollar, you're importing inflation.
Exactly. The cost of every foreign goods is higher with a weaker dollar, and the US runs a massive trade deficit. So that means they import way more than they export, and so a weaker dollar causes higher inflation in the US.
It's interesting though, Barry, because with the US dollar being weaker, as you say, we've seen a nice rally in some commodities, but also you're seeing other areas within the global markets rally, whether it's some areas within the emerging markets or other countries that perhaps nobody was really set up for seeing a rally. So, timing is everything. It sounds as though you would reverse those trades, but probably not yet.
Yeah. Not yet. I mean, I think we're still in this honeymoon period early in the year where typically January, at least the first 3 weeks of January, everybody is optimistic with a new year. They've turned the page. Everything's going to be better, especially when they look at history and virtually every year except one that I can recall, where the market was down more than 20% one year. The next year, the market rebounded pretty strongly. It was up double digits, with the exception of one year. I think it was 81 or 1980 or around 81, 82, where we had a double dip recession. But I think I don't put much stock in that data because this is a pandemic. It's not a normal economic cycle that was caused by inventory buildups or increases in interest rates or whatever. This is a unique economic event, and we have to look at it that way.
No, fair point. It seems as though, just given so much of the uncertainty that's been out there, I've been a big believer that, over the past couple of years, it has been a stock picker's market. You have to be very active. You have to understand what you're owning and why, and where you see the trends, and being able to be tactical and nimble. People should understand that your background, you've been one of the most well-known, recognized fixed income investors, which also means you trade. So my question is, are you an active trader? Is that the strategy that you're employing right now versus a long-term trend bet?
Yeah, I do. I think that there's, just in fixed income or equities, there's going to be 3 or 4 and maybe 4 or 5 big trades this year.
Okay, Barry, I'm going to cut you off there, and we'll hear what they are on the other side of the break. We'll be right back. Barry, so I want to hear what the answer is. You think that there's going to be a couple of big trades in 2023. What are they?
Well, I think it centers around Fed policy, not surprisingly. And, right now the market is in the mode that the Fed's going to be cutting, fairly quickly in the second half of the year. I suspect that's not going to be the case. But while the market's in the mode that the Fed is going to be cutting, you can see just about everything is rallying. Bonds are rallying, stocks are rallying, commodities maybe not so much, but trying to. Even crypto's rallying, everything, it's kind of the risk on trade. And I think that'll last for a little bit. That's a trade. And when the market starts to question that view, there'll be a reverse trade where you'll be able to make money shorting the market and having it go down or being in cash. And I think the market's going to vacillate 3 or 4 times this year where we're going to, we've got a positive view on monetary policy. When that view plays out and the market gets stretched, then we're probably going to have a negative view on monetary policy, and then we're going to have a down trade. And then it's going to get pushed too far, and the market will get too cheap, and then we're going to get a recovery trade. And I think the US dollar will likely lead most of those, and typically the bond market is going to lead this. So I think it's going to be a very good trading market. But I think you can definitely hold a core position in 2 to 3 year government or corporate bonds, which, corporate bonds are yielding investment grade close to 5% and high yield in the mid 6s with very little risk, higher quality corporate bonds. I kind of favor the high yield ones more than investment grade because investment grade has run a long ways and investment grade spreads for this. But I'm not really negative on the equity market this year, but I think that there's going to be 3 or 4, or maybe even 5 big swings during the year. And at the end of the year, I don't think it'll be up or down a whole lot.
Interesting. With respect to U.S. Treasuries, though, where do you stand right now in terms of going long the 30-year?
Yeah, well, it's rallied pretty good. The 10-year is around 350 right now. I think the 10-year will trade below 3% this year. But I also think that we could revisit close to 4% sometime in the first half.
Okay.
So
That
I'm
means you really
not.
have that means you really have to know what you're doing and know how to trade and when.
It's very, and the markets are incredibly illiquid and technical. And unless you're following the market technically and are competent at charting or technical analysis, it's not really a buy and hold market. I don't think anything in the world's really buy and hold right now because Fed policy is still highly uncertain. And I don't think the Fed knows what they're going to do. They may end up cutting quicker than they're saying. That's probably true. But I also think that they're going to try and hold rates high enough. And I think the economic environment is going to encourage them to that because if inflation doesn't come down quickly and commodity prices start to go back up, response to a weaker US dollar, and the unemployment situation rate doesn't rise because the labor force is shrinking,
Yeah.
then the market is too optimistic at the moment.
Barry, I want to just wrap it here with, the fact that it is, it's definitely a difficult market. There's no doubt about it, and it has been. Tell us the ETFs that you run so that people who don't know how to do this on their own, can have you do it. I've got 20
Yeah, we have
seconds.
3 ETFs that we manage through Horizons. One is a high yield loan fund. The other is a high yield bond fund. And then
Okay.
the third one is a hedge fund, HARB,
Got to leave it
which
there,
has a.
Barry. I have to leave it there. Thank you so much.